Yep, you're on.
So I know the title of it was Demystifying Stocks and Bonds, but I don't know too many people who get really excited about bonds. So I decided I would really just stick with stocks and exchange traded funds and mutual funds. If you want to talk bonds, super important piece, but I don't know too many people that go out and actually pick which treasury bond to buy or which municipal bond to buy or whatever, but I'm more than happy to help there too. So a little bit about me. I'm a Edmonds kid, grew up here, went to Edmonds Woodway. After high school, I went and joined the Navy, and I was a crypto for 10 years, working with the NSA and doing all kinds of fun spy stuff. Then I had a family, and I realized my family was more important to me than going all over the world. So I got out of the Navy. At that point, I had received a $10,000 signing bonus from the Navy to re-enlist a second time. And I didn't know what to do with the money, but I went and talked to my dad, and he happened to be a client at CWM here. And I said, Dad, I know I'm supposed to do something smart with this money. I just don't know what that is. And he said, you need to go talk to the folks at CWM, sit down with them, and they'll help you out. So that's what me and my fiance at the time did. We came in, sat down with the founder of the firm, Gary, and he talked to us about what it means to invest and that systematic investing. And he pointed out, you know, $10,000 isn't a whole lot, but it's a foot in the door, right? And I left that meeting with two thoughts. Number one, why have I never been taught this before? At the time, I was 21 years old, and nobody had ever sat down with me and talked to me about how this stuff works. My dad was a Boeing guy, and you know, he has his pension. And my mom was a housewife, and she stayed at home, and she didn't know anything about the stock market, so nobody explained this stuff to me. And I was blown away and at the same time motivated. And I said to my wife as we were leaving, my fiance, as we were leaving, that is how I can help people. That's what I can do to help people. And it was at that point that I decided I wanted to be a financial advisor and really help, because I was like, this is how I can help change lives. So that's what I'm doing right now. That's probably what I'll do for the rest of my life. I love this stuff. I love helping. It gets me excited. And every single person is a little different. Every story is a little different. And there's so many ways that I can help people just with normal, everyday questions that come up. So here at CWM, we focus on retirement, but also there's a long time between when you first start working and retirement, right? Most people think of retirement in their 50s and 60s and 70s and 80s, but I started when I was in my 20s, and I'm 40 years old, and realistically, retirement for me is, you know, 20 years out. So I've got to do more short-term, mid-term planning, because I have a wife and kid and home, and I'm still doing stuff. So I need to be able to plan for the short term and medium term and long term. We manage about $300 million in investment, in client investments and portfolio. We run an in-house management strategy. We do active and passive management. So we kind of run the gamut. And really it's about finding the strategy that's the right fit for our clients. So that's enough about us. This is really about you. In the course of the average American's life, they will earn about $2.7 million in their working career. The trick is to find a way to translate those dollars that slip through your fingers and put those into things that actually add value. So whether that's experiences or helping family or buying a home or doing something with that money, it's better to be intentional with the money than reactionary, right? I had a petty officer in the Navy tell me it's better to be proactive than reactive. This is a wonderful quote by the man himself, Warren Buffett. If you don't find a way to make money while you sleep, you will work until you die. And that is really the trick to building wealth, is use the vast resources out there to find ways to make money while you sleep, whether that's investment property, whether that's stocks and bonds, mutual funds, exchange traded funds, even if it's loans or whatever. Find ways that, you know, you go, you work your 8, 10, 12-hour days, and at the same time, your portfolio is working for you while you're working. When I meet with clients and talk about what it means to build a strong financial life, this is kind of what I envision, what that looks like. We're first going to have a conversation really about risk, because what happens if you walk out the door, you get hit by a bus? What does that look like? You know, you can no longer earn income, or you know, you pass away and you got a wife and kids, or you got a husband and kids that rely on your income. Then that's bad news, right? So a lot of our first conversations are about assessing risk, and sometimes I come across as a life insurance salesman, but that's not the intent. It's really just saying, okay, are we able to move on to the next phase, the wealth accumulation? Because I don't want to have you put all your money into the stock market if you're in debt. Then we get to the wealth building, and this is where, you know, you're buying property, you're buying a home, you're funding your portfolio, even starting a business. This is a pretty long phase of your life. And then you get wealthy, you accumulate wealth, and that's where you need to start adding in some risk management on top of that. So you say, I can't afford to lose everything that I have. Now I need to start protecting it. And then you get wealthy and you protect it. Then you start saying, oh man, now I have too much. I got to pass this on to my kids somehow. I got to find a way to pass this on to the next generation. I get this question a lot from people that are just starting out. We have this program called Starting Strong, and it's really for people who are young professionals just starting out. We have a minimum of $5,000 really just to get started. So it's super low minimum. As Brian mentioned, for our regular retirement planning client who's looking at you know, going into retirement and what does that look like, we do have minimums of $250,000. But for our Starting Strong clients, we can get started with as low as $5,000 with a goal of getting you up to $50,000 within the first 5 years. So that's going to entail putting together some short-term and mid-term goals. That's going to be looking at where do you put money as you're building your wealth.
Okay, let's go.
So we often talk about debt. Debt is always the big thing. A lot of times people's net worth is actually negative. When I first start meeting with them, they have so much debt, so little assets. So we develop a plan to get them out of debt and then build up an emergency fund. So an emergency fund is liquid, right? You want to keep your money in bank accounts, high yield savings accounts, and even this thing called a brokerage account, which is the start of wealth building. That's really where I consider wealth building to start, with a brokerage account, because then you're saying, okay, now I have money that I can put at risk. Everything before that is saying I need the money for the short-term stuff. So then you have brokerage account, and that's going to be linked to that's going to be linked to the stock market. And that's where you go and you can buy individual stocks. And so I'll get into that. And you as real estate agents, like I mentioned, you're able to set up individual 401ks or SEP IRAs or even individual IRAs, just a traditional IRA, or a Roth IRA. For younger people with a longer time horizon, I am a huge fan of the Roth. You pay your taxes today, but you get tax-free growth for 20, 30 years, and it all comes out tax-free when you do take it out. So if you have 20 or 30 years of compound growth, then let that sucker ride, you know. But as you get closer to retirement, those peak income earning years, your 50s and 60s, where you're kind of making the most money you'll ever make in your life, that's when you really want to start looking at a 401k and get the tax deduction, because you have a shorter time frame and you need the tax deduction today. So here we go, not to be promissory or anything, but this is what you'll see a lot from financial advisors. They'll just say, hey, look, if you just start saving money now and you get 7% a year, then you'll have, you know, $1.5 million. Easy, no problem. You'll be ready for retirement. The problem is, and you guys see this from the real estate side, that's not the reality. The reality is actually a lot more jagged because people take money out of their portfolio. People say, oh, well, I need to make a down payment on a house. So, oops, I'll take money out of my portfolio, so I give up that compound interest on that big down payment. Or, oh, my kid's got to go to college, I got to pay for that out of pocket, so I can't save $500 a month. I can maybe do $50 a month. But life intrudes in this scenario, and it doesn't always come out just as clean as everybody always points to. But it is a pretty chart. I love hockey sticks. I mean, it's cute, but a lot of times that's just not the reality. So you find yourself in a situation where you say, okay, now I'm ready to go. I got a little bit of money that I can put into the market and I'm ready to start. Me, I had 10,000 bucks. Okay, so my dad told me, okay, go invest. And I said, okay, what do I invest in? And then he said, I don't know. Now, it's fun. So this kind of stuff I think is fun, but I also want to differentiate that there's serious money and play money. And you want to have different attitudes with your serious money versus your play money. So this is kind of when you're just starting out and you want to do it yourself, you want to buy your own stocks and investments and do this. So what I'm going to talk about is basically opening up a brokerage account, funding a brokerage account, finding stocks to buy or exchange traded funds or mutual funds to buy, and actually purchasing them. So placing a trade order. So this is going to be kind of the nuts and bolts around buying stocks and buying exchange traded funds and mutual funds. So what you'll first do, and I'm using Charles Schwab here because that's what I personally use, but there's a number of other brokerage accounts. There's, I think one guy mentioned Vanguard, there's TD Ameritrade, there's Fidelity, there's Robinhood, all kinds of online brokerage accounts. And that's what you would want if you're going to be buying and selling your own stocks. I download the app, so I do it on my phone. It's got a fingerprint login system, so it's super easy. But the rules are basically similar to opening a checking and savings account. You have to be 18 years old. If you're not 18, you have to have a parent or guardian on the account with you. The account is going to be linked to Wall Street, essentially. So whatever you can buy in Wall Street, you can buy in this account. And you're going to link that brokerage account to your checking and savings account. So you're going to set up this thing called an electronic funds transfer and be able to send money from your checking account to your brokerage account. And if you've bought cryptocurrency before, it's the same way. And then you're going to put money into the account. Now, the difference between this account and a bank account obviously is FDIC insurance, right? This is not guaranteed money. People will often come to me and say, what kind of an interest do you earn in a brokerage account? Don't ask that question. I can talk to you about long-term average returns, but this does not earn interest. This is not a CD or a money market at the bank that's FDIC insured. This is money at risk. Just want to clarify that. So this whole idea of paying yourself first is a real big thing that I really stress with my younger clients. They will often pay their rent, they'll pay their phone bill, they'll pay their, they'll go out to eat, restaurants and stuff like that. And then at the end of the month, they'll say, oh, I got 50 bucks left, so I'll put that into my account. That's not how this works, man. Responsibility is saying you matter most. What you do is important and your life is dependent on your finances, right? So pay yourself first. I want you to think of yourself as a business and keep as much money in that business as you can. So you're going to link your brokerage account to your savings account. And one thing that I point out here to a lot of clients is this idea of saving. When I was young, everybody told me I had to save. But to me, that just meant put money in my savings account, which was so boring. Right? I wasn't earning anything on my savings. It was just sitting there, not doing anything. But nobody ever said the second component of saving and investing. That second component is where the real power is. So this is the savings and investing portion. So you're going to take money. I personally use Capital One, and I've nicknamed my Capital One account my shuffle money account because we shuffle our money all over the place from that account. And then my wife and I, we have a joint brokerage account. So I move money from my shuffle money account at the bank to my joint brokerage account. I set up a $25 a month contribution, and this is just systematic savings. Every month on the 5th of the month, 25 bucks is going to go from my checking account to my brokerage account. Obviously, you can set it up for whatever, but I'm just saying do what you can. It doesn't have to be hundreds of thousands of dollars. Just do what you can, and eventually it will increase. We usually encourage people that as they get raises and bonuses to increase their monthly contribution.
Hey, Mark, can I jump in real quick?
Yes, sir.
Just one thing I wanted to reiterate that you said that I think is really powerful that everyone on this call should really take to heart is the pay yourself first, that savings first. Like I preach this all the time too, is most people pay all their bills first, do all their expenses, and at the end of the month, they try to save, but most people don't have any money left.
Yeah.
So if you save first, that money is already set aside. Now you can live on what's left, which you then start mentally starting to adjust your budget to live off of less money, which helps you build and continue to save, which that was a mindset that I went through like 6 or 7 years ago that changed my entire financial situation. I mean, it just changed me completely. So everyone think about that. If you live your life paying your bills first and living first, and then paying yourself last, try to flip that mindset to pay yourself first and live that way and see what kind of a major change that does for you as well. Sorry about that. I think that's probably a super powerful statement.
And I saw that in the Navy all the time where guys that I worked with lived paycheck to paycheck. And this is how you break out of that cycle. This is how you get out of that rat race and into a better quality of more security. And young married people who are stressed about every little thing in their life, if you guys understand this and you guys are, my wife and I, we call it shoulder to shoulder, right? We're doing this together as a team instead of against each other, where it's more face-to-face confrontational. This is how you create more peace in the home too, by being intentional with your money. So then you say, okay, I got money in my brokerage account. Great. Now what do you do with it? You can buy stocks or you can buy a fund. A fund is a group of stocks or a group of bonds even, or whatever, that's going to have a specific strategy. So if you buy stocks, you go and you pick which stocks you like. Say, I like GameStop, I like Facebook, I like Apple, I like Tesla, I like whatever. I don't know what else is out there. Chances are it's going to be a stock that you've heard of before, because very few people are going to invest in something they've never heard of. Otherwise, they'll have to, research it or whatever. But you are in charge of the strategy in your account, basically. What those stocks do on any given day, that's all on you. Typically, there's lower costs when it comes to stocks. There's no management fee or anything in that case. More opportunity for home runs and strikeouts, much more risk involved in individual stocks. And like I said, the investor is in charge of which strategy he's running or she's running. Whereas with a fund, you can choose basically an active or a passively managed fund that has a specific strategy, and that strategy is going to say, if it's actively managed, the manager is going to go in and say, this is what we want, this is what we don't want. I'm going to be very specific in the investments inside my fund. If it's passively managed, that means that it's going to just say, I want everything that is large cap growth, or I want everything that's in the tech sector, or I want everything that's in China tech or whatever. They're just going to say, cast a big net and say, I want this strategy, and come hell or high water, we're sticking with it. A fund is going to intrinsically have less risk because it's more broadly diversified. And the investor is more focused on choosing the strategy than they are about the individual investments. So that's really conceptually the difference between stocks and ETFs, exchange traded funds. This is a fun little slide here, kind of a lot of words, so I apologize, but two of the biggest investors in the world you see right here, George Soros and Warren Buffett. George Soros makes his money on technical trading. He finds trends and exploits them. And so his quote here, economic history is a never-ending series of episodes based on falsehoods and lies, not truths. It represents the path to big money. The object is to recognize the trend whose premise is false, ride that trend, and step off before it's discredited. So, if you're looking at trends, George Soros would be kind of the model that you would follow. And if you're looking at what is it that you're actually investing in? So forget what the stock is doing right now, but what's the long-term time frame of this stock? Then you're thinking more along the lines of Warren Buffett, who's a fundamental investor, who's saying, I want to invest in good companies. I don't really care what the current price of that company is. I just want to know that that company is going to be around for 20 years, and I want to hitch my wagon to that because I believe that company is going to do great things, for a long time. So different thought process between both of them, and both of them are right. Both of them have done very good. Most people, I would imagine, are technical traders. Fundamental analysis is difficult. Most investors would say that technical trading gives you an idea of what to invest in, and fundamental analysis confirms the hypothesis. So this is my little tip of the presentation. This is my favorite website. It's called FinViz. You can go to it. Right here's the link, finviz.com, financial visualization. And it's really robust in its ability to do some nice analysis on stocks and bear down into finding stocks that you're comfortable buying. So here I've got an example of an investor who wants to buy a large cap stock that's valued between 10 and 20 billion dollars. It wants it to be a bank that thinks, well, I like the financial sector right now. It's got positive earnings and it's paying a 4% dividend. So you can really take all the stocks that are out there and start to drill down and say, this is exactly what I'm looking for, or around the area that I'm looking for. And FinViz will return different investments that you can choose from. I clicked on charts here. You'll see, give my little pen here. See the charts tab. So this shows me charts of all the stocks that fit this criteria. Pretty basic. You guys know how filters work because you do it all the time. So I'm not showing you anything you don't already know. But finviz.com is one of my favorite websites. I love it. You can also do it for exchange traded funds. You'll see here, I've selected under industry. I just want to look at ETFs. I don't want to buy individual stocks. I want to look at a fund. Okay. So then I find an ETF that's paying a 3% dividend and is priced under 20 bucks because I only put 25 bucks in my account. So I want to be able to buy some, you know. So then you say, oh, look at this guy. Look, that's going up. Let me find out more about that. So you can click on that and you can read the news on it. You can look at the moving averages. You can look at trends or whatever you want. But you can do further research based on the technical aspects of the stock.
So Mark, really quick, we did have a question that I think would be really good to bring up now. So what would be considered good as far as the dividend yield goes? Like what's a good benchmark?
Good question. Right now with interest rates so low, I would say something between 3 to 5% would be good. Anything north of 6, 7%, to me, that's saying you're taking on too much risk. There's a reason why it's paying out that high of a dividend, and especially in a low interest rate environment, something's weird there. So you want to, if your dividend is too high, you got to think like, why is it so high? What's wrong? But I think if you can get something in the 3-4% yield right now, that's probably about what the market is going to be able to provide safely and sustainably. So you say, okay, I did all my research and I found what I want to buy. This thing, good, steady growth. I'm okay with a little bit of wiggle up and down over the long term. I think this thing's going to do well. So I'm going to put money into my account and I'm going to buy it. So how do you buy it? You've already opened the account. You've already funded the account. So you're going to go and log into the account. And like I said, I'm using Schwab because this is what I personally use. But if you use Fidelity or TD Ameritrade or whatever, it's going to be conceptually the same. You're going to log in and you're going to find on the website where it says to trade. That's what you want to do. And you're going to get an order ticket. This is where you place your order. And a lot of people don't know how to read this or don't know how this all works. So I just wanted to take some time to go through it and explain it. So first thing you're going to do, you're going to put the symbol in. If it's Microsoft, it's going to be MSFT, right? If it's Apple, it's going to be AAPL. If it's AT&T, it's just going to be T. So whatever it is. And then when you put the symbol in, the website's going to tell you what the official name of that investment is. And it's going to tell you what it's currently trading at. And it's also going to tell you this bid ask. This is kind of weird. So I put a little note down here. The bid is what somebody is willing to pay you for the stock. So if you already own it and you want to sell it, you're going to look at the bid price. If you want to buy it, you look at the ask price. That is the price that somebody is willing to sell it for. So you're going to be, say you want to buy this stock, it's $35. So you say, I want to buy 2 shares of this stock. So total purchase price is $70. And you can see in my account, I've got $79. So I'm okay. Now, you should know there are some places that charge money to buy and sell. So just take that fee into consideration as well. All right. Didn't like my clear all drawings. There, okay. Over time, you'll just develop more and more investments as you go. So you'll put some money in, you'll say, okay, now I've got a couple bucks in my account. So then you take that money and you can either buy something that you've already bought before, or you can buy a new stock. This is an account that I started for my son. He's 16 now. For Christmas one year, I opened this account for him and we bought 1 share of Disney in his account. And as he's gotten birthday money and Christmas money or whatever, he's been able to put money into this. And we sit down and we talk about, well, what investment should we buy now? Oh, I heard about this really cool one. Oh, I really like playing on the Nintendo Switch. I think the Switch is going to really help Nintendo out. So we just play around with this. This isn't a very high-tech, robust account, but it's just a play account that me and him do together. So that's fun. As I mentioned, the reality is that life intrudes. Everything seems hunky-dory, and I heard a really good quote that a plan is only as good until the first shot is fired. And everybody goes into life with a certain plan, and then stuff happens. And so your job is to react, but keep the focus. There's a lot of voices out there telling us what we should do with our money. Everybody's got an opinion on what I should do with my money, but at the end of the day, I have to do what's right for me. Even those with the best intentions have a hard time staying disciplined. Sticking to the plan is important. And that's where the idea of paying yourself first comes in. Otherwise, you're reacting to a situation instead of being intentional. And once you decide what to do, finding the time, energy, and effort to actually do it can be difficult. If you're working 8, 10, 12-hour days, coming home at the end of the day and researching mutual funds and exchange traded funds and stocks is exhausting. So it may be the last thing on your mind. Helpful hint, this is where a lot of individual investors run into problems. Usually they have an over allocation to cash, or they're not well diversified enough. You saw in my son's account, he's all stock, right? And these are American bias, right? All these companies, boy, he knows what's going on with Zoom and Google and Amazon, but he doesn't really know too much about Nokia over in Europe, or he doesn't really know too much about what's going on down in Australia. So they are investing in companies that they're familiar with because that's what they've heard in the news. Most investors let fear and emotion dictate when they put money into the market and when they get out of the market. So fear and greed are big components of when they decide to invest and when they don't decide to invest. And most self-investors underperform a traditional benchmark. And you can see here that's why. Usually they're not diversified, have too much cash, and let their emotions get involved in the decision-making process. So what we have done at CWM is put together this Starting Strong program, which is a professionally developed, diversified portfolio. We use Charles Schwab as our portfolio system, and basically it's a robo-advisor that every time new dollars come in, you buy fractions of shares of different exchange-traded funds, and the money is fully diversified at all times. Along with a professionally developed portfolio, you also get somebody who's there with you. And I kind of think of it like as a coach, right? Somebody there who's just giving you thoughts, giving you advice, working with you, who knows your story, knows what your goals are, and can help get you there with a plan. If you want more information, I'm happy to help you out there. So this is the reality. This is actually what I see more often than not with our own clients. There are times when you can put more into your portfolio, and there are times where you take money out of your portfolio. There are bear markets, there are bull markets, but having somebody to do it with you provides a lot of encouragement along the way, a lot of tips and tricks and helpful ways to do it. Like, how do I reduce taxes? How do I buy this car the best way? Or just advice on different things. How do I buy some raw land, and who should I talk to about getting a loan? That kind of stuff. So you end up in a much better spot over the long run when you're working with an advisor. These are things that I always tell clients to keep in mind as they go, that progress is better than perfection. Too many people spend money they don't have to buy things they don't need to impress people they don't like. And you'll see here, I'm attributing that to Will Rogers. I don't think it's actually Will Rogers. I think it's Ed Norton from Fight Club. But this is a Chinese proverb. The best time to plant an oak tree was 20 years ago. The second best time is today. So don't worry about if you think you've missed the boat. Get started and just do it. I think it's so exciting when one of my most favorite clients is a divorcee. She basically started at zero, and she was 45, 46 years old when she just had to start all over again. And she just retired a few weeks ago, and her financial plan looks fantastic because she's kept her expenses down, paid her debts off, paid her mortgage down to a level that she can maintain through retirement, and has saved and saved and saved. So it's never too late. And time in the market is more important than timing the market. Too many people try to catch those black swan events, and they just get left holding the bag for too long. So this is my contact information. Again, if this is something that's interesting to you and you want just somebody to bounce ideas off of, or that Starting Strong program looks good to you and you want to find out how that works, I'd love to talk to you.
Wow. Thank you, Marc. That was amazing, man. A couple of things I wanted to backtrack to, if I can open up some questions for you, is on investing. Going back to stocks and mutual funds, or the ETFs, the electronically traded funds. You know, a lot of people are going to have questions about, you know, you start to get into like, you know, that, what is it called? The FinViz, which I love that system. I'm going to have to check that out. But like, I think a lot of people's eyes glaze over and they're like, I mean, where do you start? You know, you got a question about the, about the dividend, you know, and like, holy smokes, like that's a loaded question right there. I mean, you're starting to ask about that. It's like,
Right.
just pick a stock, then you got to research it and find all this stuff. You know, I always thought, like, to me, like when I'm investing, I have, you know, my managed account, and then I have my personal account that I play with, kind of like, you know, just buying stocks that I like. And that's my intent, is like, I just buy stocks that I know the company, I like the company, I either use it personally or I buy it. Can you talk to that a little bit about, you know, because most people don't want to do that. Do you feel like that most people should, if they don't want to throw things away? It's like the mutual fund, the EFT seem like a really good and easy investment that's easy to research, that you can see, okay, here's the risk level, here's the return. Can you speak to the ETFs a little more depth as far as people that don't know where to start?
Yeah, and this is actually Warren Buffett's advice, is if you don't want to, you know, go pick stocks, the average investor should just buy an exchange traded fund that trades the S&P 500 and just stick with it, because you're really buying into the 500 largest companies in the world, basically. And there's nothing wrong with that. You don't need to, you know, get alpha and maximize returns. You need to get good, steady returns. What we find in going through the financial plan with most clients is if they can get a healthy return of 6, 7, 8% on average, then their financial plan looks really good. The problem is if you retire and you take a massive hit, if there's too much risk in your portfolio and you take a 30 or 40% hit to your portfolio and you're no longer able to put money into your portfolio, or you're now taking money out of your portfolio, that's when people are not able to retire. Those situations where you have too much risk. So an exchange traded fund with a well-diversified set of companies is a great way to do it. And I would probably say start out with S&P 500 exchange traded fund.
Super easy, you just buy the same thing and you're automatically diversified, and someone's actively managing that too, correct? I mean, well, I guess it's S&P 500, so you're just invested in the top stocks in the country.
The S&P 500 theoretically is an actively managed program, right? It's constantly dropping companies out, moving companies in as they grow. So a company like Microsoft at one point was not in the S&P 500, but as it grew, it moved into the S&P 500 and another company dropped out. So it's not necessarily actively managed, but it has its way of active management.
One other point too I wanted to make real quick, and then we'll get to everyone's questions. I really apologize, is that last point you made about people overreact and they jump out of the market. You know, they try to time it, like, okay, like in March, last March when the pandemic started, I was talking to people in May and June that I just got off all of my stocks and I sold everything when the stock market went down. They already lost 20%.
Yeah.
Then they sold everything. Then the stock market rally and went up 40%, and they just lost out on 60% gain. Can you speak to that too? Because I think that's really important, is a lot of people see the risk and don't realize that a lot of it's just short term and you got to ride through that.
You know, with our clients, we had a number of clients who had told us, hey, I've got some money on the side. I've just got it sitting in my bank account. I've got like $20,000, $30,000 just sitting there. Can you tell me when it's a good time to put it in? And so we reached out to those clients. We keep them on a cash list, and we harvested that list, and we were making phone calls saying, don't let this whole idea of the economy shutting down scare you. Now is a great time to put your money in the market. The horse is already out of the barn, is what we like to say in those times. You know, you're already down. It's not like the global economy is going to go away because of COVID. It's going to recover. These companies know what to do. They know how to have a strong balance sheet. And there's a lot of good things that are happening in response to this. I mean, interest rates, were, they absolutely came down. The Fed said, we need to help out. So the Fed started pumping money into the system. All that money's got to go somewhere. So it went into asset prices. So we've seen home prices and Wall Street absolutely run uphill because of all the stimulus. So you just got to keep a long-term perspective. There's always going to be something around the corner that scares people, right? That's how the 24-hour news cycle makes its money. It scares people. It tells people what they should be afraid of and who they should be afraid of and who their enemy is and all this stuff. I think it's terrible for America, but they make their money scaring people. And you have to say, I have more emotional intelligence than the whipsaw that the media wants me to have. So I'm going to stick to this for the long term. Did that work?
That's great. I just want to remind everyone as we come up on our last 5 minutes that this is being recorded. So if you have to jump off right at 11, no worries. We're sending the recording to you. But we do have a couple questions to go through. So we'll just start at the top and work our way down. We had a question from Joe. How do we decide if we should use a 401k versus a Roth 401k if we have a regular Roth plan also? So that one's a little bit more specific, but if you can talk a little bit to what we should be investing in.
Sure. So when it comes to kind of the tax strategy, I'm a big fan of lower income, younger people. Traditionally, I'm going to say do the Roth. As your incomes grow, I'm going to point you towards the traditional 401k. You get phased out of being able to make tax deductible IRA contributions. That's your individual retirement account, but you never get phased out of being able to make 401k contributions. So when your income starts to grow, your 401k is your biggest asset, right? That's where you're going to be putting as much money as you can into that. Before that, when your income tax range is in the, call it 22, 25% range, I'm comfortable with Roth contributions at that point. But when your income starts, household income, say around 200,000, that's when we start having the conversation about the traditional 401k.
All right, awesome. Moving on to Daniel's question. Can you discuss expense ratios and the importance of finding ETFs that have low expense that won't eat into your gains?
Sure. This is a big thing that it's out there. Low cost investing is important. And typically what we see with mutual funds specifically is that there's a load involved in mutual funds, and a lot of institutions and mutual fund companies have realized that's their Achilles heel compared to exchange traded funds, where they're just too expensive for the average investor, and you're not really getting more investment performance in a mutual fund than you are in a exchange traded fund. So a lot of mutual funds out there are actually running their expense ratios down to be competitive with exchange traded funds. So if you're seeing an investment expense ratio of over 1%, you're probably paying a whole lot of money for the management. And so you should demand better performance. You should say, I don't mind working with a hedge fund if I'm getting better performance, but if it's going to get the same kind of performance that you can get in a cheaper fund, then just go with a cheaper fund. Also, with an exchange traded fund, it's available for intraday trading, meaning you can log in and, oh my goodness, the stock market is down 3% today. I want to sell out of everything. Or, man, I think now's a great time to buy. I'm going to buy an exchange traded fund. Whereas with a mutual fund, they all settle at the end of the closing day or of the trading day. So everybody else gets to eat the low-hanging fruit, and you get what's left over with a mutual fund.
All right. Do you think we have time for one more, Mark?
Oh yeah, sure.
Perfect. Our last question is from Christian, and he says, is it common to have multiple portfolios, one for more risk and the other that is a little safer, or would you focus only on one portfolio?
It just depends on the person and what their mindset is. Like, we have clients who say, this account is for a home purchase, but this account I'm making regular contributions to, and I don't need that money. That's my kind of long-term money. So you can say different accounts have different strategies, and you would invest differently based on what those strategies are. Yeah, totally. I do it myself. I have my own self-managed play account, and then I have my more serious long-term money.
Love it. Well, thank you so much, Mark, for coming on and sharing all this good information with us today. I know I learned a ton, and I'm sure a lot of other people on this call did too. We're just so grateful that we were able to have you.
Well,
So for everyone that was on this call today, again, you'll be receiving a recording of this video. We'll also send out Mark's information again, in case you didn't get that on that last slide there. And yeah, thank you so much for being here.
Thanks for everyone for joining us. Really appreciate it, man. That was amazing. Thank you so much for opening up the doors there for a lot of people on this call. I'm super excited as well. I learned a lot as well. So thanks again.
appreciate it.
Thanks, everyone. Have a great day.